You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Volatile and choppy, just two words used to describe the market this week. Recessionary fears remain a major market headwind. Certain technology shares added to the market malaise late in the week. That was due to a glum reaction to the earnings of Dell and Hewlett-Packard. Some consumer stocks, though, moved higher earlier in the week on the hope that the back-to-school shopping season would in fact be a good one. On Thursday, though, a little bit of an ominous sign for the broad market emerged as the Dow Transportation Index, largely seen as an economic barometer, dropped 2.39%. There was a bit of an uptick in merger activity this week, but the stream of weak economic data overall offset any encouraging corporate news. And summer vacations kept trading volume light. And as we all know, when you have a lot of people away from the trading floor and light volume, you could have exacerbated moves in the market. Bring in Shiraz Mia now, who is our research director here, right?
Sure.
Any move in the market could be exaggerated when trading is thin like that.
That's right. That's right.
So let me ask you, my friend, do you think that we're getting closer to a double dip? Maybe a little bit closer than most people would like to believe?
I don't think so. I've never been a taker for the double dip theorist. My sense is that the fear is there, the concern is real, but there is enough strength at the core in the economy that even this soft patch that we are seeing right now in the second half of 2010, we will go through it. There will be positive growth. It may seem to a lot of folks as recessionary and very close to a recession, but not a recession. We're coming down from a 3.5% GDP growth rate to something in the 2.5% vicinity. And then from 2011 onwards, we go back to above trend growth. So I don't buy into the double dip fears.
Okay, quickly, no deflationary period either.
Deflation is another thing. I think it's a passing fad. We have come out of a very big recession, the biggest in the history since the Great Depression. So the CPI data is at a very low level. But you would expect that coming out of a recession with so much slack, both in the labor market as well as in the broader economy.
So deflation, yes or no?
No.
Okay. Get right to the heart of that one. So you still believe that even though we've seen now a lot of money coming out of stocks and going into bonds lately, because we're in a period reminiscent of Japan in the 90s.
That's right.
As far as economic slow growth is concerned, you still believe stocks are the place to be.
I do.
So give me some weekend wisdom, if you would, on what's the one main reason that people should be looking at stocks to invest in now?
Let me briefly touch, Terry, on why folks are running away from stocks first.
Well, we know why they're running. They're scared.
They're scared. And the reason they're scared is that they're talking about deflation, they're talking about double dip, they're talking about Japan that you mentioned. And Japan has had this decade of stagnant growth and deflation combined, which dropped down their stock market to significantly low levels.
Right.
Those fears, in my judgment, are completely exaggerated.
Okay.
And the positive numbers that we had been seeing in the bond market, and the treasuries included, I don't think those have staying power going forward. And if anything could give positive outsized returns for investors, that's in the stocks. Why stocks? Because stocks and the companies are in excellent condition. We saw that in the second quarter. We saw the expectations that managements came out and stood behind. So the earnings outlook looks very good. Balance sheets are in extremely good condition. We have more than $1 trillion on their balance sheet. The largest accumulation of cash in a very long time, and valuation multiples are at very low levels. So yes, we have had subpar returns this year. We have had subpar returns relative to bonds in the last decade, but the outlook going forward for the stocks is much better than any other asset class, and that's why investors should be overweighting and giving larger share to equities and stocks in their portfolios.
Interesting. What's on your radar for the week ahead?
there's not a whole lot of major economic news. We are through with the second quarter earnings season.
Right.
So the words that you used in your piece, choppiness and volatility, I would expect that to be a recurring theme in the coming week as well. Investors have been fixated and concerned about the health of the economy. And any of these economic news stories coming out making more concern about the health of the economy would be the key discussion points throughout the week.
You think this weak data is going to pressure the market into a sell-off at some phase?
I would expect the overall tone to be downward in the coming week, yes.
Okay. Just the coming week or foreseeable future?
We need to see some positive evidence that yes, the economy is not going into a double dip. Yes, the deflationary fears could be contained. So once that happens, then we'll see stability in the market.
All right, there is more still ahead. Stay with us. Here is your Bull and Bears stock of the week. A chemical company and a specialty retailer make up this week's Bull and Bear of the week. Shiraz Mian, Research Director, back with us once again to elaborate on each of those. The Bull of the week, is Eastman Chemical Company. Boy, you're hung up with the Eastmans for the past couple of weeks.
It appears like that. Yeah, that's right. So Eastman Chemical, it's a mid-cap chemicals producer, about $4.5 billion market cap. They have revenue about $6.5 billion.
Okay.
Three basic reasons why I have them as the bull.
Yep.
They're very well positioned to benefit from the restructuring efforts that they very well executed over the last few years. That has really improved their earnings and margins outlook. That was the second point. And third, they pay a very good dividend. They have solid balance sheet, and their financial outlook and cash flow outlook looks very good. So briefly on the restructuring efforts over the last 4 or 5 years, prior to 2008, 2009, they essentially divested or closed down facilities and businesses that constituted about a third of their revenue stream.
Wow.
So what they did was the more high cost, the more commodity, the more low margin, and businesses and segments that did not really were in sync with their long-term goals and their core business operations. What that did was, with the downturn came, they were in much more leaner and in much more better position to withstand that. Their earnings are less volatile and less cyclical now. Very strong earnings outlook. They have been beating expectations for a number of quarters now. The margin outlook looks extremely good. And all of that is showing up in cash flows. They have a pretty healthy free cash flow yield right now. Pay a very good dividend. Currently yields about 2.5% to 3%. So a pretty attractive name all around.
All right, and the Bear of the week is PetMed Express. You don't hear too much about them a lot lately.
They are, you could broadly call them a specialty retailer. 1-800 Pet Meds. They are in the obviously in the pet meds. 2/3 of their revenue comes from the over-the-counter pet meds, and 1/3 the prescription drugs. Two main reasons. The competitive environment is very challenging for pet meds. And that's showing up, the second point being that's showing up in their margins and earnings. Briefly on the competitive environment, they very heavily relied on this last-minute advertising, TV advertising for customer acquisitions.
I see.
And that market has been effectively shutting down on them. So they don't have access to that very effective advertising. Their customer acquisition costs have been increasing steadily. We saw that in the last few quarters, and that's showing up in compressed and depressed margins, and then that's affecting the bottom line. Now, it may not just primarily be the last-minute advertising segment where they have problems. It could be the competitive environment as well. A number of other better capitalized and larger retailers are getting into this segment too, and it's getting difficult for these guys to really compete as effectively as they have in the past.
All right, let's leave it there. More Stock Talk is still straight ahead. Stay with us. And now, Stock Talk. analysis of stocks in the news. Well, Microsoft stock is down in the neighborhood of 19% so far this year, and that's worse than the overall tech sector performance. So we felt it was time to call in our stock strategists, Tracy Reinick and Michael Vodicka, to take a little bit of a closer look with us at this stock. Microsoft, down. That's like you never hear those two words in a sentence generally. So is this reflective of just the soft PC sales, or is there something more than meets the eye?
Who knows? I mean, I do think they're
Okay, well, that wraps up this segment.
well, I mean, I think they're in a sector, part of the tech sector that's not the glamour side anymore. You know, that's shifted over to Apple and Google now, and Microsoft, oh, they're old and beyond. They're not in the in thing. But, you know, they still make the software that runs on basically every PC in the world.
Right.
So, you know, they're churning tons of cash every quarter. They just had a great quarter for their fourth quarter they just reported. Sales were up, you know, double digits. All their segments were up. The PCs are, you know, people are in the corporate side are going to be replacing their operating systems. They are going to start upgrading.
Right, and so some analysts are predicting that that could be a big resurgence.
Exactly. And
Yeah.
they saw Windows Office, actually, the sales were up 15% in just this last quarter, and that is more of the corporate side. So, you know, and like I said, they have tons of cash. They have $36 billion sitting there, and, you know, maybe not as much to do with it. And they're only trading at like 10 times earnings. That's also cheap.
Right.
But again, they're not kind of on the glamour side anymore. That's shifted to these other tech companies, and investors just feel like after, you know, the last 10 years of waiting for Microsoft stock to do something, that maybe they're going to get out because it's not gonna.
So no red flags on the fundamental side.
No.
Not from where we sit,
No.
anyway. Mike, what about on the momentum picture?
Well, the longer term picture, what Tracy kind of mentioned, is that Microsoft has been pretty flat for about the last 10 years. You can look at this chart, it's a 5-year chart, and the shares are actually almost dead even from where they were 5 years ago. So there hasn't been a whole lot of direction. It's been a pretty flat trade.
Kind of like the rest of the stock market.
Well, that's what I was going to say. Is, I mean, if you look at the charts of Microsoft, it really does have a fairly strong correlation with the overall market, and we've definitely seen that play out recently. Our next chart is a 6-month chart, and you can see that shares of Microsoft topped off in April with the market, and they recently kind of rebounded. But in terms of direction moving forward here, you know, like Tracy said, sentiment, that's a big factor. Microsoft is no longer the sexy stock to own, so it's kind of fallen out of favor with investors in spite of the fact that it does have the strong fundamental profile.
All right, so no momentum red flags at this point either, just steady, flat performance is basically what I'm hearing. So does that mean that everybody's attention now has shifted to the iPads and all of that stuff, and Microsoft just doesn't have a strategy for that?
Yeah, I mean, it's between the smartphone and the iPad, the tablet. I guess they're coming out with a tablet soon or something like that. Or, you know, I mean, they keep trying to go in with the strategies. They had that smartphone and then they withdrew it from the market after a month.
Right.
That wasn't good. They still have the Xbox, which is doing okay, but it's always lost them money and it continues to lose money. They have Bing, their search engine, which is also doing better, but it's also losing money. You know, but they still have the PC. They still have their main underlying business, and nobody does it better than they do in that. And it's not that the PC is going to go away because people are buying the iPads. It might eat a little bit into the netbook market, which is Microsoft's next kind of big, strong selling point. But, you know, worldwide sales are still going to be strong on the PC side and on the computer side, where they're going to be using the Windows operating service. You
think it's inexpensive here, the stock?
Yeah, it's a great value play here.
Okay. Well, that is our latest view, their latest view on this particular stock in the news. They'll keep tabs on it for us and alert us to any red flags that may pop up here as we go forward. There's more still to come. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Recent uptick in merger activity this week is being viewed as a bright spot, especially as second quarter earnings begin to taper off and the economic news continues to disappoint. So let's see what our market mavens think about this recent uptick in merger activity. We have Shiraz Mian, Research Director, and almost a brand new panel this week. Tracy Reinick is here, as is Bill Wilton, two of our key equity strategists who appear here with us regularly on Profit from the Pros. Tracy, I'm going to start with you.
Okay.
We've got a situation here where up until now, deal activity has been kind of weak.
Yep.
But we also had a ton of cash being sat upon by these companies out there.
That's right.
Until they could find a way to take advantage of the current conditions without really increasing their risk profile
Right.
too dramatically. So, the deal activity that we saw come out this week, is this a sign that companies are gearing up for better times, or that executives are just becoming restless?
It's kind of a combination of things. They are going to be able to get some other companies at pretty good prices, so that's why they're moving in. But it's also a matter of they might not be able to grow their company as quickly as they can organically, and this is an opportunity for them. Like you said, a lot of them have cash, especially technology
Right.
and the resource companies, and that's where we're seeing a lot of the activity right now.
Right.
And like in the resource companies, if they can't get the reserves out of the oil out of the ground, they're going to go out there and try to buy it. And that's what we're seeing. So it's kind of a combination. They still think the demand is going to be there and things like that. But with some of the prices the way they are, the cash they have on the books, they can go out there and get these resources easier than finding it themselves.
And to Tracy's point, Bill, actually, the weak economy could be helping in the deal making because you got low interest rates now on corporate borrowing.
Yeah, that's definitely going to be helping. I mean, the financing that we're seeing there are a lot of all-cash deals because people think that their own stock is undervalued. So that's always a good sign. It shows some optimism there. But the other thing is, Tracy mentioned they are pretty much just buying growth rates because they don't have as much organic growth opportunities. And when you see all these companies coming out of the recession, their balance sheets are very cleaned up. They're running lean and mean, which makes them even more attractive acquisition targets. So, I mean, that's kind of the combination you've got here. You've got a lot of efficient companies, the cheap lending, and people needing something to keep their growth rates going.
Shrez, earlier in the program, we were talking, and you said that over the near term here, we could see the market sell off a little bit on the weak economic data that keeps pressuring the market. But this deal activity over here, are we looking at maybe higher stock prices ahead as a result of the deals?
Well, it's a positive for the market, definitely. It's from these corporate titans who have a very direct and first-hand eye on the economy and on the operating environment. When they are coming out and using pure cash to buy another company to bulk up or to grow into a new market or a new product, that's a sign that they feel comfortable about the outlook going forward, and that's reassuring for all of us. So we have been saying that, yes, the economy is slowing down, but the corporate sector is in very good shape. So you mentioned the cash. We saw the earnings in the second quarter. We saw that management teams, by and large, came out and stood behind the earnings expectations for going forward. So we will have 35-40% earnings growth in 2010, another 15-20% growth in 2011. In fact, by the middle of 2011, we will reach the prior peak in earnings that we had reached in 2007. So the companies, the corporate sector, are in very good shape. And now, as they are getting more comfortable with the operating environment, both for here and globally, they're going in and bulking up and so it's a confidence boosting signal for all of us and for the market. So in that respect, it's a positive thing.
So Tracy, up until now, we saw investors actually beginning to turn to dividends for income. Deal making helps dividends, hurts dividends?
It doesn't, for a lot of these companies, some of them aren't paying it anyways, so they're using the cash in other ways.
Oh, okay.
It depends, but usually it's not a big factor in these kind of deals. But yeah, dividends are a great thing for a lot of investors right now, and they definitely are seeking out the yields. I've seen a lot of the higher paying dividend companies, the stocks are holding up a little bit better here, and I think that's because people are trying to get in there to get the yields.
Okay, give us your top stock pick of the week.
I have New Skin Enterprises, which is skincare products. They do a lot of anti-aging products, which is hot right now.
I have to look into.
Well, I know it's not just for women, and they saw a record quarter in the second quarter. Revenues were up 20%, and a lot of it was in China. Their Greater China, which included Hong Kong, was up 53% in the quarter. Okay. So things are looking good on the skincare.
So they've got some skin in the game, as they say. Bill, what you got for the top stock pick?
Buffalo Wild Wings. One of the things I really like about them is that their outlook is the same place it was earlier this year, yet they've seen a sharp sell-off that they've yet to recover from. So there's definitely a lot of upside here in the stock, and they are one of the few companies that are able to grow organically, like we talked about. They're opening up a lot of chains. They've got a very aggressive expansion strategy right now. Like you said, the cheap financing and a lot of other factors are in their favor. When things do turn around and consumers return, they're going to be in a very good position to really take advantage of that.
All right, and you, sir?
A far less exciting name than what these guys said, Deere and Company. It's machinery, agricultural machinery, construction machinery, but primarily this is a pick on the health and outlook of the worldwide agricultural machinery market. The ag commodities market is on fire. I think the outlook for the commodity prices, all the agricultural commodity prices is very good, which adds to the liquidity and the purchasing power of these farmers, and that's the primary reason for my pick on Deere. On top of that, they pay a very good dividend, currently yielding in the vicinity of about 2%, so a very good solid pick.
Okay, I already asked you this question. Tracy, since you look at the markets as well for us from time to time, what's on your radar for the week ahead?
There's not going to be a lot of news out there, so it's going to be trading a lot on rumors and other things, but I do think we're going to continue to see some surprising announcements like the M&A and maybe things coming out of Europe or China that could be more of a movers, but I think people are kind of still on vacation, so they're not going to be back for a while.
That's right, we said that earlier too. Trading volumes have been light. One thing on your radar for the week ahead, Bill?
I was actually going to bring up the trading volumes as well. You see this a lot when the heavy hitters come back from vacation. They're the really ones that decide where the market's going to be going.
Okay, let's leave it there. We hope the week ahead is a profitable one for you. Thank you for joining us, and we'll see you next time.